Nvidia briefly reached a market cap of over $1 trillion in late May of 2023. It didn't last long after their stock price had dropped shortly after. The company's stock price has tripled over the last 8 months alone, and investors are both excited and concerned. While the impressive growth of Nvidia has enabled its shareholders to enjoy a period of excellent capital gains, abnormal growth comes with massive downside risks. Given the circumstances, should investors go all in on the hype, or will Nvidia come crashing down sooner or later? Based out of Santa Clara, California, Nvidia is a technology company known for designing and manufacturing graphics processing units. In recent months, the company has been riding the AI wave, which has allowed it to make amazing gains. The Nasdaq 100 index, which comprises some of the biggest tech giants in the world, gained 1.7% purely because of Nvidia's amazing performance in the stock market. Nvidia's stock soared 25% as it defied all expectations and grew higher than what analysts expected. This is the direct result of the company's contribution to the AI market, for whom Nvidia provides processing units. Other chip makers, including TSMC and AMD, also saw their stocks grow alongside Nvidia. These companies saw their stocks go between 8 to 12% high. It must be noted that among investors in the US right now, there isn't much to be optimistic about. The US government was in deadlock for most of May over the debt ceiling crisis. President Joe Biden and Republican Speaker Kevin McCarthy had a number of disagreements over the matter, which was finally settled in June. However, their indecisiveness could have forced the US into a payment default. In such a scenario, markets would have crashed all around the country. Currently, there is still the risk that the US dollar loses its status as the global reserve currency. Despite all these troubles, Nvidia's earning reports have become a reason to celebrate among the investor community. David Bahnsen, Chief Investment Officer at the Bahnsen Group, said that all that matters for the market are the corporate profits. Nearly every S&P 500 company has reported first quarter earnings at this point. Surprisingly, 78% of them have higher earnings per share than what the analysts had expected. The S&P 500 companies are on track to have their greatest performance since the 2021 fourth quarter. Within the S&P 500 itself, Nvidia has practically done better than all the other firms. The company's price-to-earnings multiple sits at 47.23. To put that into context, this value is far ahead of the industry average of 18.1. This means that investors expect much higher returns from Nvidia than its rivals, like Qualcomm and Intel. So why has Nvidia done so well? Well, with the growth of the artificial intelligence sector, big tech companies have shifted focus to AI, hoping the technology will attract demand. However, as it stands, the computers that run AI require a microprocessing chip called the graphics processing unit. Nvidia controls 80% of its supply. As such, AI's growth fuels Nvidia's growth, which in turn enables AI to train and operate at a larger and larger scale. It's a win-win situation for both. CEO Jensen Huang has said that his company is ramping up production to meet the massive demand for AI technology. Nvidia in the past focused on catering to the gaming industry, as well as the cryptocurrency market, which was going great for the company a few years ago. This was around the time of COVID-19 when gaming and crypto markets were at their peak. However, with time, both markets started slowing down massively. Nvidia had an oversupply problem with its GPUs in the gaming sector in 2022. The company had to stop manufacturing more units. It was forced to sell many of its GPUs at discounted prices just to get rid of them as demand was falling. The demand shock can be seen in the fact that Nvidia's gaming sector revenue was just $1.53 billion in 2022, which was 51% less than its 2021 revenue. The lagging demand from the Chinese market throughout 2022 put Nvidia in a difficult situation. During the fiscal Q3 period, Nvidia also launched the GeForce RTX 4090 graphics card, which has been selling out despite its high $1,599 price. But even so, the product failed to prop up Nvidia's gaming revenue in the quarter. The other factor behind the falling demand has been the decline of cryptocurrency mining. Back in September 2022, Ethereum ended GPU-based mining, which had been driving Nvidia's graphic card sales over the past 2 years. By March 2023, Nvidia had made its position in the crypto market very clear. In a statement addressing the issue, the US chipmaker said cryptocurrencies do not bring anything useful to society. Despite the company's processors selling in huge quantities to the crypto sector in recent years, Nvidia has turned its focus on AI completely. And this has caught the attention of the big tech companies. In recent weeks, Microsoft said it had bought tens of thousands of Nvidia's AI-focused processors, the A100 GPU, in order to power the workload of OpenAI. Nvidia has sold 20,000 H100s to Amazon for its cloud computing AWS service, and another 16,000 have been sold to Oracle. Nvidia also rents access to the chips directly. Speaking at the company's annual conference last week, CEO Huang described the company as the engine behind the iPhone moment of AI and said that the generative AI his firm powers would reinvent nearly every industry. The dependency on Nvidia is so wide that big tech companies have been working on developing their own computing chips. Apple has spent years developing its own processors so it could avoid having to rely on and pay other companies to outfit its devices. Google has built its own tensor processing units for several years, and both Microsoft and Amazon have programs to design their own units as well. However, as it stands, the dominance of Nvidia is set to continue for the foreseeable future, given that the company has a major head start on big tech and would take years before their GPUs are replaced by a competitor. And when Nvidia says that they would reinvent every industry through the AI they power, they aren't messing around. At Computex 2023, Jensen Huang showed the world a glimpse of where Nvidia was headed. While playing a game, Huang displayed the ability to talk to the characters in the game. This shows the use of generative AI's ability to comprehend human language and its reaction to it. Nvidia's processors were powering this generative AI. The brilliant performance of the company reflects directly in its market performance. Year to date, Nvidia shares have skyrocketed by almost 162% after crashing in 2022. For the current quarter, Nvidia forecasts sales of $11 billion, which is 64% higher than last year. That target has already obliterated Wall Street's estimate of $7.2 billion in sales for the second quarter. In the first quarter, Nvidia's data center sales rose 14% year over year to $4.28 billion. That growth reflected strong demand from large consumer internet companies and cloud service providers for its graphics processing units and related tech. However, despite the indicators proving that Nvidia is on the right track, investors are worried about the stock, with some going as far as calling the stock extremely overvalued. So, why is that the case? Chip stocks like Nvidia fluctuate a lot, meaning that stock being overvalued or underrated is not uncommon. And a lot like processing chip stocks, something that goes criminally underrated is the love and support of our viewers. Be sure to keep supporting us by pressing the like button and helping the channel out. Now, back to the video. Stocks that fluctuate a lot can give rise to a bubble, which, once it pops, would cause that stock to lose a lot of its value. This exact scenario has played out in the past. In the 1990s, Cisco became the face of the internet hype. Institutional investors continued to calculate how many applications of the internet there would be. The higher this number, the higher the demand for Cisco's routers and internet infrastructure. This meant that investors kept raising their price targets for Cisco stock. In the end, the investors were right about the internet becoming as big and important as it is, but they grossly overestimated Cisco's role in the internet's growth. Cisco's stock price eventually came crashing down, cementing the stock as one of the 90s biggest overcalculations. And investors feared that Nvidia may be going down the very same route. This doesn't mean that Nvidia would fail, but simply that the hype around it may be too much for any company to justify. While some analysts can go as far as calling Nvidia a $10 trillion company for the future, people can't get carried away, and that hurts the average investor. But why should the average investor be concerned about hype if Nvidia has such a huge impact on AI, which in turn is changing the way our world works? Well, simply because the numbers don't suggest that Nvidia's valuation is justifiable. If we take a look at other trillion-dollar companies, there's a huge difference. Google, Microsoft, Apple, and Amazon all have 12-month revenues of at least $200 billion each as of May 2023. In stark contrast, Nvidia has collected a measly $25 billion in revenue over the last year. When you pit Nvidia against its fellow trillion-dollar companies, one of the standout metrics is its price-to-earnings or PE ratio. Essentially, A PE ratio tells us how much investors are willing to pay for a stock based on its earnings. A ratio between 20 and 25 is considered a good PE ratio, and anything above it could mean that the company is overvalued. Microsoft, a long-standing trillion-dollar enterprise, has a slightly overvalued PE ratio of 35.8. Nvidia, in comparison, boasts a PE ratio of over 180, meaning that investors are paying extremely high inflated prices for Nvidia stocks. Very similarly, Tesla stock also boasted high PE ratios when the stock was at its peak a few years ago. The company was expected to do really well, but by the end of 2022, the stock had fallen over 70% from where it was being traded in November 2021. Tesla, much like Nvidia, was a fast-growing small company, but the revenues couldn't catch up to the hype train. It's worth noting that Nvidia was worth just around $250 billion back in October 2022, when the stock price stumbled around $110 a share. Their market cap has grown extremely fast in a very short amount of time. However, despite growing as high as they have, the company only pays out dividends of 0.04% on stocks. This is embarrassingly low for a company with a trillion-dollar valuation, but it starts to make sense when you take into account that other trillion-dollar firms bring in at least 8 times the revenues which Nvidia brings. However, despite the cautions being thrown around this stock, Nvidia has a few things going well for them. For a company of its size, Nvidia has maintained almost equal levels of both market cap and enterprise value. Market cap is the number of shares a company multiplied by its share price. Enterprise value is the total market cap plus a company's debt. When both these values are similar, like in Nvidia's case, it means a company has practically zero debt to pay off. Nvidia is also expecting to see a boost in its revenues as early as next quarter, according to CEO Huang, who believes at least a 50% rise. More reasonable estimates predict that Nvidia would take its $25 billion revenue to $42 billion in the current fiscal year. Within 2 years, Nvidia is expected to be bringing in more than $60 billion in revenue alone. A stable rise in revenue would allow the company to grow organically. Wall Street has also taken note of the performance of Nvidia's stock performance, with many institutional investors raising their price targets for Nvidia, some going as high as $500. Some of the most well-established names on Wall Street, including Bank of America, Jefferies, and UBS, maintain a buy rating on the stock, as they expect it to go beyond its current price. Meanwhile, Stifel maintains a hold rating on the stock, becoming one of the few investment banks that did not raise the price targets for Nvidia's stock beyond $400. There are mixed signals in the market for Nvidia stock right now. Some investors feel that there's no ceiling for the company, while others are playing it cautiously. Realistically, even those investors who are conservative about Nvidia are not doubting the capabilities of the company. Instead, they're simply worried that the stock price in the short run seems to have peaked at the $380 to $400 range. These investors are expecting the stock to drop before it goes back up. The question to ask right now is, where realistically would Nvidia find itself in 12 months from now? Market research firm TrendForce estimates that Nvidia's new H100 and H800 data center chips will witness stronger demands in the second half of the year. Analysts also expect the gaming GPU market to clock annual growth of 15% over the next 5 years, further suggesting the bad days of Nvidia's gaming business could be over. CEO Jensen Huang has also come out saying that greater production capacity has been secured for the second half of 2023. Meaning that the company would be able to meet the growing demand for its GPUs and secure more revenues as a result. All in all, Nvidia seems like a really overpriced stock because the numbers say so. However, Nvidia is also poised to be one of the biggest benefactors of the AI surge, as its GPUs are the most important building blocks in running artificial intelligence. Moreover, more analysts are sure that AI is not simply a trending market like electric cars and cryptocurrencies. These factors make Nvidia different from the former overhyped stocks like Tesla. As such, Nvidia may be a good investment for the long term if investors can buy at the right time. Many stockholders of Nvidia are choosing to hold their stock, but not buying any more, indicating that even though they think the stock is overpriced, they believe it'll yield some value in time. If you enjoyed this video, be sure to hit the like button and subscribe to our channel. Thanks for watching, and see you next time.